Okay, hello everybody. Thank you for your patience there. As always with these things, there's a few late joiners. I'm sure a few more people will join us as we go on, but we will crack on with today's webinar and get straight into it. So today we're talking about and offering our views on the macroeconomic environment, inflation, central bank monetary policy, financial markets, and then some investment strategies to protect wealth in these uncertain times. I mean, it's a webinar that we thought of doing some time ago, and I think even more appropriate to do so now, given what's going on in the world. So a quick kind of rundown of what we will cover. So we'll give you a very brief introduction to who we are. Some of you attending today, we've already met, so you won't need that, so we will keep it nice and brief. Then we will cover the macroeconomic environment, supply chain disruptions, global debt and Fed and the other central banks' monetary policy. We'll move on to the US dollar and the effect on that on currencies. A bit of a conundrum that's being faced at the moment, inflation versus recession, how that may play out, and the financial markets. Then for the next section, we will cover the investment implications of what is occurring at the moment and what sort of kind of strategies can be used to protect wealth, what sort of asset allocations should be appropriate during this sort of period. At the end, we will be answering any questions that you may have. So please feel free to submit these throughout the webinar. We won't be answering this as we go, but if you can, submit your questions and we will get to those at the end. Okay, so who we are. So Matt Penfold, director here at Fiduciary Wealth, and with me today is Paul Correa, our managing director and one of the founding partners of our company. Firstly, I must say today, you may hear it in my voice, despite it being beautifully warm out here, I've somehow managed to get a cold, but luckily Paul will be doing the majority of the talking today. So Paul, thank you for that, you're saving me. So Fiduciary Wealth, we were founded in 2007, a fully regulated wealth company based here in Gibraltar. But the company was actually born out of a law firm. Eastler's 1892 was, as the name suggests, have been operating now for 130 years and are the oldest law firm in Gibraltar. Now, aside from our legal roots, we also have accountancy connections. We're a member firm of MGI Network, which is a top 20 global accountancy network with tax advisors, accountant, auditors, and we're part of that network due to our ability to give tax-led investment advice to our clients. Talking of our clients, they are primarily Brits, but not exclusively. And our core markets, and I say our core markets are people living in Gibraltar, Spain, Portugal, and the UK. Again, not exclusively, and we have clients further afield and spread across the globe. So very brief outline of who we are. At the end of the webinar, we will be sharing our contact details. So if you want to reach out to us to find out more from us, then yeah, you're more than welcome to do so. So now you know who we are. Let's get stuck into the webinar. So here we have what is part one, and Paul, if we can get straight into it. So if you can start, give us an overview of the current macroeconomic environment, that would be great.
Thank you, Matt. Well, the global macroeconomic environment is deteriorating very quickly on the back of tighter financial conditions. So we have central banks increasing rates very quickly, whilst at the same time we have the US doing quantitative tightening, which is removing liquidity from the monetary system. That's exactly the opposite of quantitative easing, when the Federal Reserve was creating new money and pumping it into the system. So we have tighter financial conditions, and as a result of that, the US economy is now technically in a recession. They've had 2 consecutive quarters of negative growth, and that is classified as a recession. Now, the Fed chairman, Jerome Powell, has a different view, and he claims that the US jobs market is too robust for the US to be in a recessionary environment. Now, that's disputable, but that's what he says. And whilst that may well be true, one has to understand that the effect of interest rate increases and tighter monetary conditions take a while to work itself through the economic system. That doesn't happen immediately. So I'll give you one concrete example. The consequence of higher interest rates today may be felt further down the line in terms of large, medium, and small companies alike postponing their capital expenditure decisions, mean expansion plans. They may decide to focus on cost savings. They might decide to cut jobs to save money, and they may focus on repaying debt rather than taking on new debt. And similarly, households will cut back on their discretionary spending during times of economic strife, destroying aggregate demand in the process, and eventually, of course, that seeps through the economy and affects corporate earnings. But that has a lagging effect. Decisions made today are not felt immediately. And that's why I think Jerome Powell is completely mistaken in making a statement of that nature. I mean, the problem with Jerome Powell is that he's lost his credibility in the marketplace. He was stating at Fed Open Market Committee press conferences the whole of 2021. He's been saying, and some of you it will resonate with some of you, he's been saying consistently, inflation is transitory. Well, he's now changed his rhetoric, and he's now conceded that inflation is in fact deeply entrenched in the US economy, and that further rate hikes are necessary to try to curb inflationary pressures. At the last but one Fed Open Market Committee press conference, he said that the US jobs market was too robust for the US to be in recession. Last week, he contradicted himself yet again, and he said, and the narrative had changed completely. And he said this time around, he said there would be economic pain, and that there's a possibility of a soft economic landing, but the prospects of a soft landing has now diminished, and he now warns of a long recession. So that is not well received by the markets. And what surprises me, Matt, for someone who's heading, the top central bank globally, is that he should focus on unemployment data when even a junior economist knows that the employment data is a lagging indicator. It tells you about the past rather than a leading indicator that tells you about the future prospects. And rather than focusing on unemployment, he should really have been looking at new job openings, because that's more reflective of the current state of the economy and gives a better indication of the future prospects. So he's making, errors of judgment in his policy and in his statements. And that is, as I said, not well received. Markets crave 3 things. They crave stability, they crave certainty, and above all else, consistency in the messaging that is put out to the market. When Alan Greenspan was chairman of the Federal Reserve in the 80s and 90s, he was a master in sending the right message to the markets, as has been Mario Draghi when he was heading the European Central Bank. They know how to present or how to make statements to the market. But Powell seems to miss that point. he provides neither stability, neither certainty, nor consistency in his messaging. And I think that's the worst thing that can happen to for a Federal Reserve chairman. To be sending mixed signals can be very damaging for financial markets.
So, Paul, if I ask a quick question, I'll straight on that because I'm interested. Do you think his statements are just due to his, for want of a better word, incompetence, or is he purposely trying to mislead the markets?
Well, it's a very good question because it's one that I've considered many a time. Is this a deliberate ploy to bring stock markets down and to essentially slow down the economy and bring inflation down? Or is he just completely, as you say, incompetent? And I suspect there's a bit of both. I think on the one hand, he really wants to cool down the US economy and therefore the global economy, because inflation is running away. It's come out of the, the genie's out of the bottle. So he wants to cool down inflationary pressures, but by the same token, I think, and this is just a personal perception, I think there's a bit of naivety or incompetence on his part, and which is quite damaging for the US economy.
Yeah, no, I'd agree with that because I guess he's come out with these bizarre statements even before inflation. So yeah, I guess it's a lack of confidence issue now with him that the investors don't like.
Precisely. I mean, the economic environment is becoming increasingly challenging. There's no question of that. We have higher interest rates, which are very negative for equity markets. We have a reduction in the money supply to the tune of $90 billion a month. So they are withdrawing money from the money supply. So liquidity is the blood that flows through the economy and keeps the economy growing. When you start removing liquidity, that's really negative. You have rampant inflation with no signs of abating, and we've got a energy and food crisis caused by supply side issues, which are feeding the inflation narrative. So this is now starting to impact consumer spending, and in a large services-based economy like the US, inevitably it'll reflect in lower corporate earnings and lower equity prices. Now, not all of the sectors of the economy can pass on, and this is part of the problem. Some sectors of the economy can pass on the higher prices to the ultimate consumer, right? So their corporate earnings are not being squeezed because, the elasticity, some of the services and products they provide are inelastic in demand. So they can increase the price, pass it on to the consumer, and the consumer will keep on, are prepared to pay the new price, so to speak. But not all sectors of the economy can do that. So those sectors that cannot pass on the higher prices will see their corporate earnings being declining. And effectively that should be reflected in the stock market price. So feeding all this insecurity in the market and economic slowdowns, higher rates, there's also other things to contend with. There's geopolitical tensions between the liberal democracies and the authoritarian states. So you have, the UK and Europe and the US fighting for liberal democracy. And then you have Russia, India, China flying the flag for authoritarian states. And there'll be a tension there. And inevitably, there will be more barriers to trade, which in itself is inflationary, because, protectionism doesn't bring down inflation, it increases inflation. There's something called the law of comparative advantage. And the law of comparative advantage says that each country should dedicate their time and resources to producing the goods and services where they have a price advantage. Now, when everyone wants to be self-sufficient, and I can understand why, the gas supply issue from Russia, for instance. So you decide, I want to be self-sufficient. It means that you have to produce goods and services where you haven't got an advantage and it costs you more to produce than to import. That, of course, again, feeds into that inflation narrative I mentioned. And the war in Ukraine clearly is causing further supply chain disruptions in food and energy. And the strong dollar, which I'll touch upon a bit later, is causing havoc in emerging markets. They're having to raise rates to compete and to attract foreign capital. That slows down the economy of the emerging markets, and that in itself could be a problem for the global economy. So, in summary, the situation we're in is entirely of the Federal Reserve's doing. They did too little, they did too much too soon when the pandemic and the lockdown hit, and they doubled the US money supply from $5 trillion to $10 trillion, and then they threw in helicopter money in for good measure. And now, post-pandemic, they're doing too little, too late to mop up that excess liquidity when the economy effectively opened up. They've just let too much money chase too few goods. And you know, when you have too much money chasing too few goods, the outcome is just one. Then you have higher prices. And and the problem is one where it's difficult to see how they can wriggle themselves out of this problem, because in a normal economic cycle, you have interest rates increasing, and then they peak when an economy overheats, and then they go into a recession, and they start reducing rates, whilst at the same time making use of other fiscal and monetary tools to engineer recovery, so they can increase public expenditure, they can pump more liquidity into the market, in addition to lowering rates. But in this cycle, because it's been highly manipulated and markets are no longer free, what we have is we are entering into an economic contraction without the necessary tools to be able to engineer a recovery of some sort. And you know, governments across the globe are have large debt burdens that they have to pay back, so they can't really use government borrowings to get us out of this problem. So yeah, I think in summary, I think what you see is that governments and central banks are completely trapped, having to choose between two seemingly conflicting economic objectives, namely, do they tame inflation or do they support the economy? And they can't address both simultaneously, so they have to choose. And whereas in the past, they seem to have pulled a rabbit out of the hat and found a magic wand to deal with the issue, I think they've run out of tools to be able to get out of this one. I think this one will involve some economic pain, no question.
Okay, thank you, Paul. And you did touch on earlier, but if we can correct slightly more, the supply chain disruptions. How are they contributing to this inflationary problem?
Well, we have a raging war. We've had the lockdowns and supply chain disruption. Now we have a raging war in Ukraine, in the middle of Europe. Ukraine is the bread basket of Europe. They produce wheat, rye, oats, corn. They produce barley and they produce rice, and therefore, you know, and their production has reduced significantly, and their exports have been reduced. So in that environment, I don't see food prices correcting anytime soon. I think this will continue for a while, so long as that war rages on, and that is inflationary in itself. And then, aside from the food crisis, we have an energy crisis, because, you know, Europe has become dependent on Russia for oil and gas. And And Putin has been threatening to cut off the gas supply as a retaliation for the economic sanctions. So you've got the price of gas and the price of food going up. How can we expect, even if the high interest rates cools down the economy, the global economy, interest rates alone can't address the supply side economic issues that we are experiencing. Only supply side reforms, economic reforms, can address those issues. And I haven't seen one developed country yet to put forward any ideas on how they can address the supply side economics to try and bring down inflation. I'd like to touch on that a bit later on. But there's a lot that can be done, as I said, to address that. A more sensible approach rather than demand destruction and economic pain they could do. For instance, let me give you an example. Let's take energy as an example. It will take decades for renewable forms of energy to replace oil and gas. Yeah. During this transitional period towards zero net emissions, I think they talk about what? 2030.
I think 2030.
And then 2050. And then 2050. They talk about net zero emissions, yeah, in oil and gas. Net zero emissions. But during this transitional period, the next 8 years, 10 years or whatever, oil and gas still plays a significant and vital role in the global economy. And the big oil majors have not been investing in production for the better part of 10 years. There's been very few new oil wells, and they've decided to adopt a more financially prudent approach. So they focus on cutting capital expenditure and using that money to pay back debt, to increase dividends, and to diversify into greener energy sources. Incentivizing the oil majors to ramp up production would be a much more effective policy to combat inflation than just focusing on interest rates alone and quantitative tightening. And we've yet to see any advanced economy putting forward any proposals to try and address those supply side issues. This is what surprised me. Clearly, the West doesn't want to be reliant on Russia for oil and gas, but they're doing very little to make themselves less dependent on Russia for gas.
Yeah, so
too little.
Yeah, vocally we can say one thing, but it's all about the actions and
correct.
There's no action.
And if we look at this graph, because I think it would be very interesting to share it with the audience. It shows, exploration and production, global exploration and production of oil and gas. So the capital expenditure that has gone into oil and gas in the last, I don't know, nearly 40 years, right? And if you look at the graph, the capital expenditure peaked in 2013, which is, the top of the wave, yeah? The light blue, yeah. In around 2013. Since then, most of the oil majors haven't been persuaded that renewable energy sources are the future. They've decided, well, why should we invest in new oil wells? We would rather restrict supply and bring the price and drive the price higher to maximize their revenues. And they don't want to put capital expenditure into a business which has no guarantees of future long-term earnings. That's how they're basically pulled out, and they haven't invested in drilling for oil. They have, but not to the extent they were doing, say, in 2013 when the capital expenditure was significantly higher. You can see it there.
Yeah, which makes a lot of sense. Why would they, invest that capital and the so-called, demand will go down.
All the governments have been pushing for a shift from dirty fuel to clean energy. This is a normal reaction from a private company to cut back on their expenditure.
Absolutely. Good. And so we talk about the global debt and huge amounts of global debt. So are these levels sustainable? And if not, what can central governments do to remove us from this mess?
Well, Matt, they are not sustainable. They cannot be sustainable. You know, during the pandemic in 2020, global government debt rose 13% in 2020 to 97% of GDP. And it has continued rising ever since. I mean, I find this graph particularly interesting because, and I apologize to viewers because it's a bit,
it's not the easiest.
It's not the easiest one to follow, but basically what it says on that graph is at the center, the bullseye, at the center of this graph lies Japan. Japan has a debt to GDP ratio of nearly 260%. That means for every one, let's call it in pounds for simplification, for every £1 of income in the economy, £2.65 is owed in debt. They are the most indebted country globally, and they have been since the 90s and their property market crash. The second ring shows countries like Eritrea and Sudan and
Suriname, Cape Verde,
exactly,
and
but
a couple of interesting ones, Italy and Greece.
Italy and Greece. Let me touch on that. But look at the third ring, and who is in the third ring? Well, in the third ring we have US alongside Cyprus, alongside Aruba, alongside Bahrain, alongside Mozambique and the Maldives. And yes, you have developed countries like Canada, Cyprus. Well, Cyprus is questionable, France, Spain, and Portugal. So debt to GDP ratios have continued to soar. But the US is already running at 133%. 103% of GDP would mean for every $1 of income in the economy, $1.33 is owed. And that's a lot. This is worse than countries like the so-called pigs, like Portugal, which has a debt to GDP of 130%, or indeed Spain, who has a debt to GDP of 120%. And as I've said, there's even African countries there. But you know what's particularly interesting, Matt, and I think worth mentioning, it's not, the US is not even far off from Greece, that had debt levels of 146% in 2010, when they received, I don't know if you recall, the first EU bailout to avoid crashing out of the EU. The narrative then from the EU, from the IMF, from all these global institutions, right, including the global media channels, was that Greece was effectively bankrupt. And they had to save Greece to help the European Union from disintegrating. Well, today Greece has a debt to GDP, if you see on that image, of 206%. Significantly worse than it was 12 years ago. But everyone turns a blind eye. No one is prepared to say anything. You know why? Because the problem is so endemic in advanced as well as developing countries that Greece is no longer the bad apple, yeah? And Greece's situation has deteriorated so much that they don't want to remind people that it was only 146 when everyone was professing that Greece was bankrupt. And they were, don't get me wrong. But no one mentioned Greece now. And what a lot of people don't realize, that the Greek bailout was not so much about salvaging the Greek economy and ensuring they stayed within the European Union. It was more about saving the French and German banks that had collapsed under the weight of the debt that they had extended to Greece. And without a package to salvage the French and German banks, they would have gone under. So that had nothing to do with Greece. It was presented as a, let's help save Greece, but actually they were saving the whole EU banking system, because you can imagine the contagion effect if the main French and German banks were to have defaulted or to have had a Lehman Brothers situation as in 2008. So this was all about averting a banking crisis within the EU and the collapse of the European Union as we know it. I mean, since the global financial crisis, many advanced economies are in financial trouble. And you mentioned Italy, and that's an interesting one. Italy has unfavorable demographics. They have a debt to GDP of 155, and they have the lowest birth rate in Europe. And you know, you need people to be able to drive growth, and they haven't. And then I think last night, didn't the far right party win the election?
I think they're contenders, yeah.
I think they did win the election, or contenders, and they are all against immigration. But you know, you need people to drive economies. That's why African countries can grow, because they've got a young population. So to grasp the extent of the problem and how the powers that be have papered over the cracks in the last 10 years, let me tell you a very short story about two men and a barrel of whiskey. This story that I'm going to relate to you has been adapted from a book written by Yanis Varoufakis. And Varoufakis is a well-known author. He's an economist. He's a professor in the US and in Greece, an economics professor. And some of you will recall was the finance minister of Greece in 2015 for the Syrakis party. And I'm extracting this from a book, although I've adapted it, called Adults in the Room Taking on the EU Establishment and telling his story. So let me relate the story, Matt. So this is Cain and Abel, and they decide to lift themselves out of poverty by persuading a local publican, John, to lend them a barrel of whiskey. The plan was to roll it down the road to the next town where they were holding a large public function. And the idea was to sell the contents of the barrel of whiskey by the cup to make an incredibly big profit and repay back the publican John. And as they rolled down the barrel of whiskey, they stopped for a rest under a great oak tree. And while sitting in the shade, Cain realizes he has a shilling in his pocket. And he politely asks Abel whether he can give him a coin in return for a cup of whiskey. Abel agrees to this, pockets the coin, and gives him a cup. A minute later, Abel then realizes that now he has a coin in his pocket, and he can spend that coin too. So he turns to Cain and asks him exactly the same question. Can I pay you a shilling for a cup of whiskey? And Cain, of course, agrees to this. The process repeats itself over the next couple of hours. And as you can well imagine, after a while, the barrel is completely empty. They fall asleep under this oak tree with big grins on their faces. The publican John never gets paid. And they never go to the public function. This is exactly how public finances are being run today. Not just in Greece, but across the advanced economies. They're masking the root problem, they're kicking the can down the road for future generations to pick up the tab. They're just doing accounting of, paper transactions. But in effect, the debt is still there, they haven't generated more income, and the situation hasn't really changed. But on paper, it looks so much better. I think that's how I would sum it up. We seem to forget that the easiest way for governments, but possibly the most painful for normal citizens, to reduce the monetary value of the debt is through high inflation. So sometimes I think, Matt, are they happy to allow inflation to run riot because it's devaluing the value of that debt they have? So they're eroding the value of the debt through inflation. I don't know what the answer is. I wish I did, but it gives me that impression. Unfortunately, the problem is you devalue the debt, but you also reduce the purchasing power of our disposable income, making us considerably poorer in the process. So, inflation is taking us to financial oblivion, so to speak. So the real issue here is not that. I think the real issue is that managing your debt when interest rates are zero is very easy. There's no magic formula to that. There's zero debt servicing costs because interest rates are zero. You can borrow as much as you like. It doesn't cost the public purse anything. The problem is when interest rates start rising, as we're experiencing now quite aggressively, and governments have to roll over the debt and issue new debt at higher rates of interest. Then it starts blowing a big hole in the public finances, and more tax revenue receipts are required or have to be allocated to service that debt. This is exactly the problem that the US is facing. So US debt servicing costs are rising so fast relative to tax income, to tax receipts, that behind social insurance, behind social security, behind defense, and behind healthcare, the fourth largest item of expenditure is debt servicing. And the Federal Reserve says that we are at the beginning of a rate hike cycle. There'll come a point where they can't hike anymore because basically the public finances cannot support.
I guess it will be number 4. It will go up to number 3.
It will go exactly. It'll go to 3. It could go to 2 or to 1, and then they've got a bigger deficit, and they need more debt to manage that, to cover that hole in the public finances. So it's not clear whether the Federal Reserve will follow through on their promises to tighten, and at what point they will pivot on that and start reducing rates again.
Okay, and well, at the moment they are increasing interest rates, but in what position are they to increase interest rates in a contracting global economy?
Well, I mean, in a normal market, and this is by no means a normal market, and this is what some seasoned US professionals have been saying. In a normal market, you have to allow market forces to determine the rate of interest. So you let market forces find the right price, right? So there's something called the Taylor rule. And the Taylor rule says that interest rates should be 2-3% higher than the rate of inflation to be able to bring down inflation. Now, if we follow the Taylor rule, the rate of inflation in the US and other developed countries would be double digits, would be something like 12-13%. That's not going to happen. That's not going to happen realistically. So these professionals are saying, why don't we return to the Fed chair Paul Volcker's 1970s interest rate policy, when interest rates climbed to double digits? If we did it then, why can't we do it now? Well, I mean, that's really a dumb thing to say, because if you look at the US debt, public debt to GDP, and if you look at the graphs and you look at 1975, debt to GDP stood at 35%. So for every £1 of income in the economy, 35 US cents were owed in debt. Today, that figure is 133, we said before. So it's almost 4 times higher.
Yeah.
So the debt is 4 times higher. So whereas in 1975, the Fed chairman then, Paul Volcker, had the means to raise rates to double digits. Unfortunately, Jerome Powell is not in that luxury position of being able to do the same. So they can't increase rates as much as they suggest that they might. So it's difficult to say what is rhetoric and what is reality. But at some point, they will have to reverse that policy, because otherwise it's going to be quite damaging for the US economy and for the global economy. I think there's a few things. When interest rates continue rising, they rise to a point at which the debt becomes unserviceable. And the government will then be faced with a number of options. Do they cut public expenditure into a contracting economy when there's more unemployment benefits being paid out? Do you increase taxation? Do you do a bit of both? Or do you raise more debt and go back to the addiction? More debt to cover the budget deficit, yeah, because they'll go into deficit.
Yeah.
And then they will need more debt to be able to sustain the public services that the US government is facing, and other countries are in a similar situation. So you cannot get out of a debt crisis by taking on more debt. So they have two options, credible options: cut public expenditure or increase taxation. And that's why in a contractionary environment, it's difficult to say whether this is viable. And we are in uncharted territory. We've never been in this position before because the markets are highly manipulated, and it's difficult to say how much interest rates will have to rise by to bring inflation down. And it's anyone's guess. And it's difficult to say, but trying to apply some logic. If interest rates were 16, 18% under Paul Volcker's regime in 75, and they had a deficit of 35% of debt to GDP. It took rates of whatever it was, 14, 15%, 18% to bring down inflation. With debt 4 times, 400% more now, it would only take a quarter of the interest rates that. So I'll give you an example. If it took 16% to bring down inflation in the mid-70s, when debt was only 35%,
yeah,
it would, and now debt is 4 times more. It will take 4 times less in interest rate hikes to bring down inflation. So one could reasonably assume that between 4 and 5% is the absolute tops before the economy folds, yeah?
Okay, no, I get that, because people talk about their mortgage interest as a practical example, and I've read some people saying, we've had mortgages of 12, 14% interest rate before, we dealt with them then, why can't we deal with it now? But the problem then was people had very little mortgages and very little debt, whereas now people were saddled with much larger debt, therefore a small increase in interest rates has a much larger effect. Is that effectively what we're saying?
No, that's correct. And besides that, everyone that has joined the housing market in the last 10 years or so, they've been accustomed to 0 interest rates.
True, yeah.
So when they look at their disposable income, very little of their disposable income went into debt repayment or debt servicing, not repayment of capital. So they've been accustomed to having free money. And there's no such thing as a free lunch, right, Matt? As we know, they've had a free lunch. Now interest rates are moving higher. It won't be long before people start struggling making payments. The value of the disposable income is being squeezed by inflation, because food prices are going up, energy prices are going up, the economy is contracting, whilst interest rates are going up, and that's another squeeze on the consumer. So how much can the consumer put up with before everything collapses? That is the $1 million question. I don't think anyone knows at what point the tightening has gone too far, but I think the economy is already broken. 2 consecutive quarters of US economic growth, of negative growth, indicates that it's already broken, and they're continuing to increase rates. So I think that will destroy demand in the economy. I think we'll see the housing market, the US housing market, possibly collapse. With it comes the stock market. The jobs market will weaken, no question. And then discretionary spend by consumers will decline. And that will precipitate a recession, the length and duration of which is anyone's guess. And yet, will they then go back to cutting rates and quantitative easing again? God knows. But I think the odds are stacked in favor of the Federal Reserve reversing its policy of higher interest rates and basically pivoting again. And I think in all probability, by Q1 2023, they may have done considerable untold damage to the economy, and at which point they have to quickly undo some of that damage. Because as we said earlier in this webinar, these rate hikes, the impact are not seen immediately. If they feed through the economic system, and the impact of those decisions are felt 6-9 months down the road.
So it's a case of the damage will start to unfold, and therefore they need to look at some kind of reversal before it becomes.
Matt, I don't know. I haven't got a crystal ball. I can't tell you when it will be, because from what I can see, there's enough damage done already to the US economy and to the global economy. So I don't know. What is the greater evil? Is it a recession or is it inflation? And the central banks have decided that their mandate is price stability. So they will do whatever it takes to bring inflation down. Now, what we don't know at this juncture is how much they have to raise rates before inflation comes down. But clearly, we are entering a very restrictive monetary environment, and things are getting tighter, and the stock markets are rocking, the job openings are dropping, and it'll be interesting to see how things develop over the next 6 to 9 months. But some kind of pivot must be on the horizon, no question.
Okay, interesting. Thank you, Paul. Okay, so we moved nicely onto part 2 there, and okay, so we've seen the US dollar strength earlier, but very much so in the kind of recent weeks. So, Paul, what's driving this strength of the dollar, but also what are the implications of this if it continues?
Well, Matt, that's a really good question. The US dollar, as you rightly say, has been on a tear against a basket of major currencies since the start of the year and earlier possibly, and reaching and then breaching parity against the euro. And I think this is the straw that broke the camel's back. Everyone talks about high interest rates, about this and that and the other, but this one is the elephant in the room, the one that could really push the global economy into a deep recession. And let me just look at that graph.
Yeah.
This is the value of sterling and euro against the dollar. And if you look since the beginning of 2021, it has dropped quite significantly, right? It peaked in June 21, and since then it's been steadily declining. So it's been an 18-month correction. And you will see that sterling and euro are strongly correlated, except in the last few days, following the announcement of this UK mini budget, in which they've taken they've been very brave in their policies of, rather than go for austerity, they're going for growth. But the market hasn't taken that very positively because it's been aimed at high income earners and not the masses, the ones that really need it the most. But the picture is very clear here. The dollar has gained considerably. It's at its highest level now in over 20 years. It's only been higher on 3 separate occasions in the past 60. And the next graph, I think, Matt, is extremely interesting. At least it is for me. And let me tell you why. This graph goes back to 1967. How much is that? That's nearly 60 years, yeah?
Yes.
Unfortunately, we couldn't expand that graph to go further back in time. But there's only been, let me explain first what the US dollar index is. The US dollar index is a basket of major currencies measured against the dollar. The euro having the largest weighting, and then the sterling, and there's yen, and the Swiss franc, and so on and so forth. But the euro is, I think, accounts for more than 50%. And it tracks the value of the dollar against these basket of currencies. And it's been measured for time immemorial. But we'll go back nearly 60 years in this graph. There's only been, and you can see the sharp increase in the value of the dollar versus this basket in the last 9 months, yeah?
Yeah, absolutely, on the right-hand side.
On the right-hand side. But if you look at the graph over 60, 70 years, there's only been 3 occasions when the dollar index has been higher than it is now. And this is what I find fascinating. One of them was in the 70s, so that's at the extreme left of the graph. And that was during the oil crisis of the 1970s, when Paul Volcker, the Fed chairman, raised interest rates very aggressively. As a result, it attracted a lot of capital into the US, the dollar went through the roof. You will see that every time you see a sharp increase in the dollar index, it's then followed by a couple of years of a dollar correction. So that's one instance. Excuse me. The second instance was in the mid-80s when Ronald Reagan had this expansionary fiscal policy that he wanted to grow the economy at all costs. And of course, there was a lot of inward investment into the US. The dollar went through the roof to its all-time highs, yeah? That was followed by a very sharp decline over the next 3 years. In fact, the dollar lost 50% of its value, having peaked somewhere in 1986, 85, 86. Yeah?
Yeah.
So it declined. So that's the second time. And the third time, as you can see on the graph, is the 2001, 2002, 2003. This was when we had the 9/11, the Twin Towers, when we had the Iraqi war, and you know, the dollar is a reserve currency. In times of wars or economic uncertainty, they pile into US dollars. And that's what we have. There's only been 3 times, let me tell you again, 3 times in history of the last 60 years when the dollar has been higher. And the dollar, in my humble opinion, is grossly overvalued against a basket of currencies. There's reasons why it's so strong. And let me tell you why, because I think it would be beneficial to give reasons. I think the first one is that the US central bank have been increasing interest rates much more aggressively than the Bank of England and the European Central Bank. That policy is starting to reverse now. We've seen the Bank of England hiking rates, the European Central Bank hiking rates, and that price differential, hopefully, or interest rate differential, will be smoothened out over time. But let me tell you what the key drivers are, because I think it's very interesting, Matt. So people can understand why is the dollar, an economy with so much debt and an economy which is in recession, increasing in value. And there's 4 reasons. Reason number one, higher US interest rates have fueled what I call the carry trade. This is whereby investors swap euros, which are 0 yielding assets, and buy dollars and US treasuries, which pay 3. So Matt, you're euro based, right? You live in Spain.
Yes.
And you decide, and you've got money in the bank paying you 0.
Yes.
And you can swap your euros for the reserve currency, the strongest currency around the globe, the dollar, which is a safe haven in times of uncertainty, and the global reserve currency. And they pay you 3. What do people do? They swap.
It's a no-brainer, yeah?
It's a no-brainer. And that has been, that trend of the carry trade and the higher US rates have been driving the dollar higher. So it's a speculative and a lucrative trade, pushing the US dollar to new highs. The second reason, there's been a flight to safety, arising from economic uncertainty, arising from geopolitical tensions with Russia, Ukraine, China, and Taiwan. So those things, a flight to safety. Second reason. Third reason, the US dollar remains the reserve currency of the globe, and there is nothing to replace it yet. This is clearly supportive in times of crisis. I already mentioned during the 9/11 Twin Towers and the Iraqi war, whatever happens economically, unfortunately, that's how it works. People will plow into the US dollar because they feel safe. And the fourth one is that the US post-pandemic has had higher growth rates, GDP growth, relative to other developed economies. So in this graph, you see, starting from 2020, we had the slump because, you know, we had the first lockdown, the economies recovered, the US is growing close to 5, and then you have Japan, UK, and Germany growing at a slower rate of growth. So a stronger rate of growth attracts more capital, more security, stronger dollar. So those are the 4 reasons. Now, a word of caution. The BRIC economies are now, and that is Brazil, India, China, Russia, and South Africa. Those 5 countries, sorry, I should say BRICS, not BRIC, BRICS, are sounding out partners like Iran, because they are diplomatically detached from the US, and Middle Eastern countries to see whether they can create a new reserve currency which better serves their own economic interests. I mean, clearly, Russia in particular wants to end their dependency on the US dollar because, you know, economic sanctions have really hit them very, very hard. And they want to be in a position where they are not dependent on the US dollar. So there's some logic to this, as you know. Firstly, the share of global trade, US, let me explain this. The US share of global trade continues to wane over time. In years gone by, the US economy and the US trade accounted for a larger share of the global economy. And as the BRICS grow, that share is declining. So the BRICS want to effectively de-dollarize their economies and create their own reserve currency, which is pegged, interestingly, to gold and silver, and possibly to a wider base of commodities. In fairness to Russia and the BRICS, there's a reasonable economic argument for this, even though there might be geopolitical tensions, and they have clearly ulterior motives for wanting to de-dollarize. The BRIC economies, Matt, are significant producers of gold. I think Russia alone produces 11% of world gold production. Why should they be so reliant on the US dollar when their own currency can be pegged to gold, which is unearthed from the ground, which no one can exert any control over influence, not the US, certainly, and which is produced in abundance by the BRIC economies. South Africa and China, they produce a lot of those, you know, rare metals, precious metals and other industrial metals, rare metals, minerals. And effectively what they want to do is they want to go pre-Bretton Woods, pre-1971, and have, you know, this new reserve currency backed by gold and silver. And they can then use, of course, gold and silver as a means of transacting rather than dollars and bypassing the US dollar in the process. Let me say that the other developed economies do not build their reserves of gold and silver because they are under the influence of the US. That would be an act of war. Yeah. Because, you know, the US doesn't want the gold and silver price to go through the roof. But the BRICS have nothing to lose now. And they're not going to do it violently and quickly. But I think we're looking now at the demise of the dollar and the emergence of a new global reserve currency. And it will be sensibly, I may add, regardless of our, you know, our views on, you know, liberal democracies and authoritarian state, there's some economic rationale to what the BRICS are trying to do. So what are the consequences? I think this has been talked about for 10 years, the BRICS moving to their own reserve currency. I think that's going to happen now, not today or tomorrow, but they're now taking steps to de-dollarize. And over the long term, this will unquestionably weaken the US dollar. There's no doubt about that.
Okay. And you talk about that process that we talked about for a while and now it's happened. Is what's currently happening economically and maybe geopolitically, is that speeding along the process, or is it just it's
No, it's speeding along because now it becomes is being given a higher priority on the agenda.
Right. Yeah.
You know, they've got an issue and they want to exert more global influence.
Yeah.
One way of doing it is not being dependent on the US dollar. So I think that's going to happen. How soon is anyone's guess, but before they were making noises, now they're making, you know, when the BRICS are meeting up, it's being discussed openly,
It's getting higher on the agenda.
It's getting higher on the agenda.
Okay. Okay. And so we're still, you know, back to the strength of the US dollar because it stands, it's very strong. But what maybe people don't consider is, you know, what is the impact of a strong US dollar on emerging markets?
Matt, no one seems to be talking about the implications of a strong US dollar on emerging market economies. Even though this could actually be, as I've said, the elephant in the room, the one that causes an economic and financial crisis, because it can wreak havoc on the global economy. What I see and what has happened in the past, if history is anything to go by, every time we've seen a very strong dollar against emerging market currencies, there's a possibility that emerging market bonds will default. This disrupts the international bond markets, resulting in higher yields and increasing the risk of contagion effect across the bond markets, triggering another financial crisis of some sort. I think it's completely overlooked. No one is talking about it, and I find it odd that this is not a subject for discussion by economists. I mean, what we've seen in the past, when the dollar has risen to levels which are unsustainable for other global economies to operate, what you find is there's intervention by the G20 or general intervention to bring the dollar to a level which is more sustainable for the global economy as a whole. But this graph is quite interesting because it shows the devaluation of some of the emerging market countries versus the US dollar. So Turkish lira has dropped nearly 70%. But look, there's 6 countries there, Matt: Turkey, Argentina, Colombia, Brazil, Chile, and South Africa. 6 countries where the decline, and well, we could add euro and sterling, right? And they are not emerging countries, but we could add them to that. But these countries are more vulnerable.
Yes.
And they've seen steep declines in their own currencies relative to the dollar. Now, that has implications.
And so what sort of implications? What happens when the US dollar sees these huge gains? Well, I say when, we're seeing it now. What happens?
Well, I mean, you can well imagine, look, when the dollar starts gaining in value versus emerging market currencies, foreign investment and capital flows into emerging markets will evaporate, they will dry up completely. Investors preferring less risky assets such as US treasuries. So there's no capital inflow. And remember, these emerging countries are heavily reliant on inward investment to drive their economies. This forces a lot of the emerging countries, Matt, to raise their interest rates into a contracting economy to stem the flow of capital. So they have to offer even higher, more attractive rates to continue attracting the capital they need to drive their economies. And this has a steep dampening effect on growth. So that's the second thing. The third thing, local currency devaluations caused by capital outflows makes the servicing of the US dollar debt more difficult. And the problem with these countries, Turkey, Argentina, Colombia, if they have to go into the international bond market to raise capital and for governments to issue bonds and corporates from these countries to issue bonds for their companies or for the government or for the country, they don't issue it in their local currency. It's quite common for them to issue it in US dollars because it's, you know, there's more investor appetite to buy bonds when they're issued in US dollar than in Turkish lira. You know why? Because they fear a 68% depreciation in the Turkish lira. That's exactly the reason why it becomes more easy to raise finance if they issue their debt in dollars. Now, when the dollar appreciates strongly and they have to make interest payments on their debt and the currency devaluates 60%, then the 7% coupon on the bond that they issued is maybe now the equivalent of 20%. And they start defaulting on their interest payments. And that is the third issue. Then the fourth issue is that when it comes to paying back that sovereign debt, so one thing is paying the interest on those bonds, but eventually they have to pay the debt, right? Those bonds will mature in the bond markets. They have even more difficulty in raising the capital to pay those debts back in dollars, because what was before, let's say, an issue of $300 million in their currency, now the equivalent is probably 600 million. So you start getting defaulting not just in debt, in interest payments, but defaulting on the debt when it comes to repayment. So that's the fourth problem. And it impacts not just emerging market governments, it impacts companies in those countries and banks, all of which have large US dollar denominated debt in their books. So the question for me, Matt, is not what will happen, but when will it happen? Because the international community, as I said, will have to intervene to do something about the dollar strength and prevent what I think could potentially be another financial crisis.
So I think you teased us with this earlier, Paul. That's the right way to put it. But inflation.
Do we have another graph or what? What is this?
I think that's further down, is it?
Ah, it's further down.
Yeah. So we're still on that one.
Okay.
And yeah, inflation versus recession.
Yes.
Is that a choice? Is that a trade?
Well,
is it one or the other?
Absolutely, it's one or the other. I mean, they can't address both simultaneously because they are conflicting objectives. Either they decide to address inflation or to avert a recession. And despite the Federal Reserve's efforts to tame inflation through higher interest rates, I think for now, at least, they haven't been able to cool down prices. And to drive inflation lower, they'll have to raise rates and they'll destroy aggregate demand in the economy and they'll engineer recession. It's not the higher rates that will engineer in itself, but a point at which the higher rate, so they can't go to 12, but maybe all it requires is 4 or 5 to engineer recession, and that will bring down inflation. They know that the higher rates are limited, they have limited firepower, but they know that if they raise them enough with so much debt in their books, the economy will cave in and we will have a recession, which in itself will bring down, in theory, inflation. So I think the Federal Reserve wants to regain its credibility as the guarantor of stability of prices, of maintaining stable prices. And I think a recession is a price they're prepared to pay. I mean, in fairness, we've been kicking that road down the can for too long. The day of reckoning has finally arrived, and there's no magic bullet this time, and there's no get out of jail card either. It's just a hard reality. So what we have now, and this is, I think, for those who've joined us today, we have too many macroeconomic imbalances all at the same time. We've got the debt problems similar to the 1940s, when we had the post-World War II, when we had to borrow to fund the reconstruction, across the globe. We've got the inflationary pressures of the 70s to contend with. We've got the stock market tech bubble of 2000 with the high valuations, whilst at the same time, we have interest rates rising, 5, liquidity drying up very rapidly because they're doing quantitative tightening. Admittedly, there's still a lot of liquidity in the market. They've got 10 trillion at a rate of 90 billion a month. It's going to take them until 2026, 27 to go back to pre-pandemic US liquidity, yeah? But they are tightening up nonetheless. And then sixth, a rapidly appreciating US dollar, which is causing imported inflation across the globe. This is what people don't understand. The dollar is rising very quickly. Countries that import foreign price goods in dollars have to pay more of the local currency to buy the same goods. So that imports inflation. In the US, it's the contrary, because they have such a strong currency. The strong currency brings down inflation.
Yeah.
So the strong dollar impacts the global economy in so many different ways, including imported inflation. And that's why I say it's not, because you get balance of payments completely out of sync. If you have any doubt of this trade-off between inflation or recession, or if you in any way think we're not in the midst of a recession already, at least in the US, then you should pay attention to what FedEx, and FedEx is a bellwether for the US economy and for the global economy, to what they have said last week. The CEO, Raj Subramaniam, came out last week publicly, and he announced that they had missed their earnings expectations. So they have generated less earnings that they had budgeted for. And they cited a weakening global shipping demand for missing their earnings. And they said to expect significantly cost cutting. So they're going to start cutting costs and shedding labor to try and make up for the loss of earnings. And they have warned of a worldwide recession. Now, FedEx, the Federal Reserve have a poor track record of predicting economic outcome. But a company like FedEx, which is a bellwether for the US economy, tends to be quite accurate when they say we're not just heading towards a slowdown, we are facing a recession.
So let me understand that in simple terms. So FedEx said parcel delivery guys.
Yeah, absolutely.
So rather than kind of speculating, they can judge the strength of the economy simply by the use of their services.
Absolutely.
People are ordering less, people are spending less.
Correct.
And it's so significant that their CEO has come out with what is quite a grand statement.
Absolutely. I mean, he came up and has made it very clear. And I think FedEx have much more credibility than the Fed chairman, Jerome Powell. But talking about contraction, let me show you this graph.
Yeah.
This is the Purchasing Managers Index for US, Japan, Europe, and UK. And it's an indicator of business conditions. And the PMI is what economists look at to see whether the economy is slowing down or whether we're in contraction mode or expansion, right? And normally what they say, if the index reading is greater than 50, then we are expanding. If the reading is lower than 50, then we are contracting. And besides the absolute number, you have to look at the trend. So if you look at the orange one, which is the US, it's just dipped below 50. So they are contracting.
Yeah.
Japan is the only one with a reading of 51. However, if you look at the trend, it's sloping downwards. Yeah. So before long, they will be in recession too. The UK is already in recession. And sorry, I'm mixing the line. The red line is the EU. They've just dipped below 50, so they are in recession. The UK is the worst performing of the four. They are in recessionary, in a contractory environment, clearly. And the US are the same. They already started contracting in May of this year. So this is evidence that the global economy is already contracting now as it is. So what FedEx are saying and what the economic data suggests is one and the same thing, that we are in a contraction.
So we move on to the financial markets, and I think a lot of people maybe are here today to find out our view on that. So stock markets. Okay, Paul, where are they heading from here?
Well, there are different methods of valuing stock markets, but the most widely used measure is the price earnings ratio. And this tells us whether markets are overvalued or undervalued. We have already seen the US equity market drop off 30% since November 2021. So there's been a steep correction. Now, markets are forward-looking, right? And there's two components to the price earnings. There's price and there's earnings. And the price has already fallen 30%. But what we've seen is that the price, the earnings, which we're talking about corporate earnings of US companies, just to give you US as an example, have proven to be much more sticky. So earnings have held well, but we've seen the price come down. Now, we have yet to see a decline in corporate earnings. I think this is now the beginning of the decline. So whilst the price has come down 30%, the earnings have remained strong. And what we'll see is as soon as the earnings start dipping, the price will have to, of US equities will have to fall further to justify the valuations. So I think high interest rates, liquidity withdrawal, that will start impacting corporate earnings, and stock markets will inevitably trend lower to reflect a new economic reality. So there's further downside in US equities, there's no doubt, across different sectors, but particularly those that are interest rate sensitive, like tech. You know, like in every market, they don't all perform the same.
Of course.
You know, value stock actually could perform reasonably well and bounce back really strongly, even if there's a recession, compared to growth stock. Growth stocks are more vulnerable and susceptible to interest rate increases because that's the nature of the beast. Okay. So we wouldn't be surprised to see the S&P fall below 3,000. So another 20% decline in US equities. But when I say this is the general market, each sector is different.
Okay, wonderful. So I think that really nicely takes us on to the part three, the final part, and because I think maybe the webinar's been a little bit kind of doom and gloom, is that fair to say? But I think you've alluded to it there, Paul, is of course there'll be areas of the markets which are a lot more vulnerable, but there will be opportunities elsewhere.
No question. Look, when risk is off the table, even assets which are cheap initially will fall, but then they will recover very strongly and quickly, right?
Yeah.
And then it will set them off, and it will be the fuel that drives them to new highs.
Okay.
But in the short term, they will dip because investors and particularly small investors, the big banks are doing the contrarian, the Warren Buffett approach. When the market is dipping, they're buying in. They're taking the risk because they know that is the small investor that is driving it lower. So you don't have to have the mentality of the small investor. You have to make sure you're in the right assets, but equally that you do not panic and you don't make hasty decisions. So in a market like this, Matt, you have to remain calm. You have to have a long-term mindset. You avoid making hasty decisions which result in losses, and you just accept that the market goes through cycles, right? We've been spoiled since 2008 because there's so much quantitative easing, liquidity into the market, that everyone seems to think that the market only goes in one direction. It doesn't. We just need to make sure that my advice is always have a bit of liquidity, because there's going to be fantastic opportunities to step in, and a bit of liquidity is not a bad thing, and then be in the right sectors and avoid interest rate sensitive sectors where possible. But as I say, the key is always to remain calm, see the bigger picture, and it's always in times of uncertainty and volatility that we see the best long-term investment opportunities. So focus more on the long term, on value than growth is my advice.
Okay, great. So you know, those looking to kind of protect their wealth, what sort of asset allocation strategies, without giving away too many secrets, of course, but you know, what sort of asset allocation should they be focused on?
Well,
with that in mind?
In order to answer your question, let me tell you other developments that are happening. Russia supported by the BRICS, is looking to launch the Moscow Wealth Standard. So the letters are MWS, Moscow Wealth Standard. It's going to compete with the London Bullion Market Association, which is the LBMA, because the LBMA, in fairness to Russia, has been known for systemically manipulating precious metal prices to the downside. They've been doing it forever. And we've seen, was it JP Morgan being fined and a few other US banks?
Yes.
They've been doing it continuously, is what I said. You know, they are making money out of the market, but driving the price of gold and silver lower. So quite rightly, what Russia is trying to do is normalize the functioning of the precious metal market. Remember, they extract, they unearth gold and silver. They would be the main beneficiaries of a higher gold and silver price and other base metals. So why would they not want the prices to find their true value rather than the manipulated price that we see today? So that's happening. It's no secret, Matt, that some of the larger US banks, what they do is they sell gold and silver futures in the market. So they take short positionings, so they sell it, push the price right down, and then once the price is right down, they do two things. One, they buy the physical gold and silver commodity, and they start effectively stockpiling physical gold and silver at a lower price. And then they cut their short positions and they buy because they're in profit. So this is like the cow. So they're milking the cow with the futures market, short selling, whilst building positions from those profits in gold and silver for the long term. So yeah, it's very smart, isn't it? But you know, that has to come to an end. So we continue to recommend a few things. But look, before I go into the detail, the price of gold historically tends to track the money supply. Yeah? So in the US, they track the M2 broad money supply. So the more money that they create in the system, the more the gold goes up. It's a perfect, almost a perfect correlation, or it has been for a while. You can see divergences there, but in 2011, when we had the end of the bull market in gold and silver in 2011, you see the gap there really closed down, yeah, almost fair value. Admittedly, there was still more money supply, but the gap was effectively closed. Similarly, in the 80s, when we saw the silver and gold price very high, it was bang in line with the money supply, right? Look at the spread now between the US money supply and the price of gold. You know, the price of gold has never been more discounted to its fair value. So I'm not saying that the price of gold will go to 5,000, because who knows? But there's a strong possibility that that gap will close significantly. And that's why anywhere between $3,000 and $5,000 for gold is a fair value. So it could double, it could triple in price.
Yeah. Okay, wonderful. And what, besides precious metals, what about kind of asset allocation?
Well, anything which is an inflation hedge, and you know, strangely enough, you know, they might break the economy, inflation comes down, and then that might be the point at which we see another rally, which is almost counterintuitive, right? It makes no sense.
Yeah.
But that's what's happened in the past. They bring it down, and then gold and silver will fly off. So I would say gold and silver, all the other base metals, you know, copper, Dr. Copper, as they call it, nickel, platinum, even rare metals like lithium. So anything to do, because we're in the early innings of a commodity cycle. The last commodity cycle ended in 2011. We've had a bear market in commodities for 10 years. And now we're seeing the beginnings of a new cycle in commodities. It's going to go higher, Matt. I can't give you a date and a time
Yes.
because there's so many factors that play a part, but there's no doubt that we're heading in that direction. So buy the precious metals, buy the base metals, buy the agricultural commodities because of the food shortages and the fact that we are overpopulated. And as the global economy continues growing, there's going to be more food shortages. Buy energy, oil and gas, because we are shifting towards the green economy, but there's been an underinvestment in oil and gas, significant underinvestment, and we're not in a position yet to go fully green.
So we need
For
to
the
fill that gap.
Exactly. There's going to be another 10, 15 years when there's going to be a shortage of the renewables will not be enough to meet the global demand for energy production. Oil and gas has a significant vital role to play in the economy. So I expect to see energy prices, if they bring down, if they engineer a recession, the price of energy might go back, but take the longer term view.
Yeah.
Because I think we are, and then buy infrastructure, because in times of economic strife, governments will invest in roads and railways and bridges and airports. Infrastructure, good hedge. I think we've bought some underperform well.
Yeah.
Buy value stock rather than growth. Value stock are the ones that have deeply discounted prices relative to their fair value,
And
because
less sensitive to interest rates.
and less sensitive to interest rates and more insulated from the global downturn. It might still go down, but it recovers quickly and it preserves value better. And then, thematic investments like we hold, like, electrical vehicles for the longer term. Investments that we know, the 5G and things that we know that are longer term in nature, and keep a bit of cash. Because in markets like this, cash can be king. And I understand the argument and the rationale for saying, why will I keep cash when it's losing value at the rate of 10% a year?
Yeah.
Maybe, but if the market declines 50, 40%, you're buying assets at discounted prices. You more than make up for keeping something back in cash, holding back a bit.
Okay.
So that is in a nutshell, without going into the specifics, because I think this has already gone on for an hour and a half, and our listeners will be tired of so much detail to take in.
No, I have one quick question off the back of that, Paul. So when we talk about the investment strategy in cash, what if somebody said, well, shouldn't I just go completely in cash now?
I wouldn't go completely in cash, because no one comes to the door with a bell and tells you the market has bottomed. No one comes and tells you the market has reached its high point. There will be sectors and areas that are going to perform during this period of uncertainty. And you have to be in the market, in the game, to benefit from a recovery, because markets, as you know, Matt, move very quickly. It's impossible sometimes to deploy capital, because then you wait the decision. No, it's gone up 5, it's gone up 10. I'll wait a bit more, it's gone up 20. I'm still nervous, and you never catch the bottom or the top. So be in the market, in the right sectors, with that long-term mindset. Warren Buffett, probably the best investor globally, or George Soros, doesn't buy for the here and now. They look, particularly Warren Buffett, he looks at the heavily discounted prices and says, for the next 20 years, this is going to give me a fantastic return. And that's the kind of mindset you need. And
I guess the problem with the cash approach is that you're actually, people come to me and say, oh, I'll take risk off the table, I go into cash, but you're actually replacing it with a different type of risk. Because as you say, no one can kind of predict the bottom of the market, and you're effectively gambling on the ability to hit that, which no one can do with all certainty. And I guess it's a thing that you don't know we've hit the bottom until it's long gone.
There are times when you need a lot of cash, because the risk is so high that you go, you know what, it's worth having X number in cash. It makes sense. But generally speaking, no. But having a bit of cash, and a bit can vary depending on the individual. It can be, for some it's 10, 20, 30%. But in that region, yeah, that you can deploy as and when the opportunity arises.
Okay, so you're exposed to, interesting areas that have value, but also you have that.
But let me emphasize the point again. Some people think that when you buy in, you've got the bottom. Speak to any of the leading investors globally, Dalio or Buffett, or you can never time the bottom. So the important thing is you evaluate, you determine that there's value long term, that you're buying at a discount, and then you accept that you might not have bought at the bottom, that there might be further downside. But you're looking the longer term, and it's a question of holding out to reap the benefits of taking that position.
Perfect. Well, Paul, let me thank you, because there's a lot of detail and a lot for people to take in there. So really appreciate that, and I'm sure those watching and listening have too. I think we did have a few kind of technical problems where people haven't joined, so we will be able to send out the webinar to everyone, and there might be certain aspects that people want to take a kind of relook at, because as you say, there's a lot of detail in there, so we will be able to send that to everyone. If there's any questions, people want to send this through. There was one early from Robin there. Do the CapEx figures include shale exploration?
I wouldn't be able to answer that question.
We had earlier.
Thank you, Robin. We can try and find out, but it captures really oil and gas. Not quite sure whether shale is included, but shale is a relatively new source of energy. It may well do.
Yeah.
I'm not in a position to give you a definitive response.
But we're happy to, we can look into that and come back to you.
But I would imagine that shale, being an alternative source of energy, would fall under that category. I imagine, but that's not a definitive response.
Okay. Well, look, it doesn't look like we've got any more questions there. So hopefully that means that everyone's enjoyed the presentation, and there's been kind of value in there for all of you that have joined us, and the fact that you stayed with us for such a relatively long webinar is really appreciated. So look, thank you everyone for joining us. We appreciate your time. If you want to reach out, our contact details are there. But yeah, other than that, yeah, thank you, Paul, and thank you everyone. Have a lovely rest of the day.
Thank you.
Thank you. Bye-bye.